In 2026, many early retirees could see their health insurance premiums double or even triple from what they're paying today because of new healthcare rules about to take into effect. I'm Matt Calcagno. I'm a certified financial planner and advisor, and we help clients with tax planning, early retirement planning, especially subsidy planning, right? So in this video, I want to spend some time walking through exactly how the rule currently works and what you should do about it right now, given we have a little bit of time left here in 2025 until the new year when things could change. Now, to give you a quick history lesson, in 2021, Congress passed the American Rescue Plan, which made additional health insurance financial help available to those on Obamacare. Now, that one change made early retirement dramatically more affordable for millions of Americans, and it's sort of a tax loophole for many early retirees that have millions of dollars saved who are able to have dirt cheap health insurance premiums. And as a disclaimer, I don't have a crystal ball or any information on what Congress will do when it comes to this new change, and nobody knows if Congress will extend these rules so you can still take advantage of them. But if you don't already know about these subsidies, I'm going to show you how it's possible because it's much easier than I think people think about, but also we're going to talk about what to do if it does expire. But first we need to talk about why people even get confused about how these subsidies works, and I think oftentimes the confusion comes down to a few things. Number one, thinking premiums are based on how much you spend. Number two, your total net worth or maybe the size of your portfolio, but what they're actually based on is your modified adjusted gross income, or MAGI, or MAGI, however you want to say it. Now that means for some of you, you may have $3 to $5 million in assets and still qualify for these subsidies, but only if you understand how the income formula works. And if you know how to control it, it gives you massive leverage. That's how someone who retired early, maybe they're spending $120,000 or $200,000 a year while paying only a few $100s per month for health insurance. But the most interesting thing today is that if you compare the new rules, they're pretty brutal. Now, if you're a two-person household and you have a modified adjusted gross income, again, that key number there of about $85,000 in 2026, it could be a very dramatic difference. Now, you're in the subsidy danger zone, what they call it. Now, you're 2% over the poverty threshold. If you're even $1 over this limit, you're going to get penalized pretty significantly. With the current law in 2025, your cost of a plan would be about $602 per month, whereas without these enhanced credits, it would be about $2,652 per month. Now the big twist, now hold on, we're not done here. If we made just $400 less and we're exactly at the poverty line here, well, you go back to have a significant amount of financial help. Premiums only increase slightly. Now, maybe you're asking, okay, what is this modified adjusted income? How do I actually calculate it? Well, basically it includes things like interest from your savings accounts, dividends, even tax-exempt interest from municipal bonds, capital gains, Social Security, and IRA withdrawals, just to name a few. Now, you add all those up, and that's how you get your MAGI. Now, every dollar counts, which can seriously make a big planning difference. Now, if you have no choice but to draw more to spend and live your lifestyle, this is where the system gets brutal. Again, if you go even $1 above, it's like a cliff. You lose every dollar of subsidy instantly versus the gradual loss of subsidies that you used to see. This is why planning is so critical. It's not a slope like it was in 2025 where they start to slide away as your income goes up. It's a cliff like this orange line right here, and why it's so critical for your tax planning to understand these numbers. So how do smart retirees not blow this up? Now, there are really three common mistakes that could cost you and put you in a position where you don't get to take advantage of this. Number one is holding 100% of your assets in pre-tax accounts. That can eliminate all flexibility if you need to use that money for spending and you get above that limit, because again, every dollar you spend counts as income. Now, for some of you, that's unavoidable, but for others, that might mean you want to plan ahead. If you're about to retire in a couple of years, by building up different buckets, if you ever wish to retire early, you could be putting yourself in a position to avoid that. Mistake number two is claiming Social Security too early. Now, once that starts, you lock in that income and you can't turn it off. That can mean, again, it adds to your MAGI. That income cliff, that income can trigger a higher MAGI, which could get rid of the subsidies. The third one is copying someone else's modeling instead of modeling it for yourself. Now, these premiums vary by state, by county, by household size, so you can't rely on someone else's math. I've included a calculator in the comments below that can give you a good idea or ballpark if you are eligible for subsidies, but ultimately it's going to be specific to you, and you cannot rely on a YouTube video or any friend or article to match your exact situation. So those three are probably some of the biggest mistakes I see in terms of subsidy planning, and each one can blow up that subsidy window, especially next year in 2026. So what happens if these enhanced subsidies really do expire? Number one, who gets hurt most and what can you do now to prepare? Now, here's the thing. This video isn't fear-mongering. This is about being proactive, not reactive, because while many will get blindsided, unfortunately, those who understand this now can actually come out ahead. So let's start with who gets affected the most. That's going to be somebody whose modified adjusted gross income sits near that critical subsidy threshold. Again, for a couple, that's around $84,000. So you could see your premiums skyrocket once those enhanced subsidies end. That again is just for a couple, but it's a must-know number depending on the size of your household and your unique situation. But that also means this number, your MAGI, is one of the most important levers you can control in your retirement planning. So here's what I recommend doing right now if you are in the situation or even if you're not. Now run both versions of your plan, one modeling your spending, taxes, healthcare costs with subsidies and without them. Now when you do this, you stop guessing, you start seeing how it might affect you. Now, does that change your retirement? Perhaps it does. Most people fear uncertainty, but when you quantify it, when you see the worst case, you can start to reclaim control. I did this for a client the other day and their plan still looks solid. In fact, we were modeling out that would pay much more in premiums than having the actual enhanced subsidy. So it's good to plan for both. Now, number two, many wealthy retirees have avoided Roth conversions to purposely keep income low to qualify for those subsidies. Now, if 2026 arrives and the subsidies vanish for you, that strategy might flip, right? Suddenly, a Roth conversions may make a little bit more sense because without the subsidies, you can finally start shifting money into those tax-free accounts. And then lastly, this is unfortunately reality. And as much as I want to talk really positive on this channel, I would be remiss if I didn't encourage those that are really affected by this to have a plan B. Now, that might mean, unfortunately, delaying retirement or spending less, or for some of you, that might mean instead of a full retirement, it's maybe part-time work, maybe something a little bit more enjoyable. Now, there are over 22 million people receiving these enhanced subsidies, so this is a big deal. So yes, 2026 brings change, but for those of you who model this now, who know their MAGI, and you can use this window to maybe reposition assets or reposition your plan, when 2026 does happen, you'll already know your numbers, you'll have a strategy, and the option is to put yourself in the best possible position with the cards that were dealt here. But like I said, again, if ACA subsidies disappear, you're not completely out of options, but you need a new game plan. So for some of you, that might be a completely different income strategy. That could help you avoid maybe a future tax problem on the horizon, like Medicare IRMA or large tax bills due to required minimum distributions. In this next video, we'll talk about how smart Roth conversions can help you avoid some of those tax bombs and keep your retirement tax bill from surprising you. You can click that right here to watch, and I'll see you guys over there. Once again, this is Matt Concagno, Certified Financial Planner Advisor at One Degree Advisors. If you'd like to talk to me or someone on my team about your plan to retire early, you can click the link in the description below. We'd love to chat with you.